Welcome to the Stablecoin Podcast. I'm your host, Luther Madej, Head of Payments at the Algorand Foundation. We bring the voices of operators, infrastructure builders, and strategic thinkers that explore how stablecoins are transforming real-world finance. Today, we're joined by Edward Woodford, co-founder and CEO of Zero Hash, the crypto-as-a-service infrastructure powering major players across payments, custodians, tokenized funds, and trading platforms. But before we get started, the views expressed here are those of the hosts and guests and do not reflect their organizations. The podcast is for information purposes only and is not to be taken as legal, financial, or investment advice. Welcome to the show, Edward.
Yeah, good to see you.
I know we've talked quite a bit in person in the past, and can we just start with the amazing success that Zero Hash is having, has had? You guys have almost 2 billion in tokenized fund flows across 22 blockchains. You're powering some of the largest financial institutions like BlackRock and Franklin Templeton. And let's not even forget the fact that all this has culminated in the $100 million raise. But so first of all, congratulations on all that. And, how did all this get started? Your MIT background is impressive in itself, but then if you can kind of get us started with the transition from starting out with MIT and your vision for Zero Hash and how that has culminated to where we are today.
Yeah, absolutely. So, the 2 billion was actually just in one quarter, in Q1. So it was 2 billion of, inflows into tokenized funds, which accounted actually for 36% of all, inflows into tokenized assets, which I think reflects the importance of stablecoins in the broader story of tokenization. But, to answer your question, in terms of how we got started, so founded the company in 2017 with the premise that crypto is a technology as opposed to a standalone asset class. And that obviously plays out in payments, that obviously plays out in tokenization. And so when we started, it was obviously just the nature of the business. It was much more crypto orientated, but actually now over 50% of our flows are stablecoins. About 2 years ago, 5% of our flows were stablecoins, which I think really reflects the growth of the stablecoin part of our business. The crypto element has grown exponentially as well, but just the velocity of stablecoins is even quicker. So we were founded on the premise of we want to abstract away the technical complexity related to cryptography as a technology, as well as the regulatory complexity, allowing both innovators at small companies and innovators at big companies to use this technology as part of their core stack. And that's now reflected in some of the names that you mentioned, ranging from Franklin Templeton, BlackRock Spittle Fund, Stripe, Shift4, Interactive Brokers, Kalshi, Tasty Trade. So really a whole cross-section of types of institutions that leverage Zero Hash as their core technology stack, as they embed this technology into their core business.
What I love about what Zero Hash is doing is that quite often you find providers that are very verticalized, right? They're like, okay, we're going to go focus on trade finance, or we're going to go focus on remittance. But I think to be not on the retail side or on the customer facing side, but to be kind of on the backdrop of it and providing these crucial services, I think is something very different that Zero Hash is doing. And and you can see this exactly how you mentioned it, which is across so many different verticals. And I think we should slowly, for the audience, unpack these various verticals that you guys are engaged in today. But before we get started down that path, why are stablecoins having the moment that they're having now, right? Like you said, they've been around. Yes, they're growing in percentage overall, but what is it about stablecoins versus the other assets in the digital asset space, and what is really driving that adoption?
Yeah, so when we look at stablecoins, and I'm asked this question a lot, right, is what has been this inflection point? Obviously, we've seen technological evolution, and other pieces there. You've obviously seen the regulatory shift as well, obviously in both, for example, the US with the passage of the Genius Act, as well as in Europe with clarification around stablecoins. And I think you'll see acceleration of that, not through kind of the passage of law, but in terms of regulatory clarity. I mean, for example, August 5th, the SEC put out comments around what they will deem as potentially leveraging stablecoins as permissible capital. And it's really going to be around the ability to redeem stablecoins into cash, which is something that we've been talking about for some time. We published a white paper on the importance of redemption and the mechanism of redemption for stablecoins. So we're glad to see, different regulators pick that up in terms of how they think through the applicability of stablecoins more generally. For me, the biggest shift in the last 18 months has been the distribution of this technology. I sometimes use the stat that in the last 12 months alone, or 12 to 18 months alone, about 750 million people have access to a stablecoin through what I term a primary account. And what I mean by a primary account is an account where people already hold money today. Now, of course, stablecoins are a store of value, and so people may just hold stablecoins for a long period of time. But for me, I really try and lean into stablecoins as an alternative payment method. And we can talk more about the important metrics about what that means to be a payment method. But effectively with, for example, the last 18 months, Revolut, Robinhood, PayPal, Nubank, just to give some names, now have the ability to access stablecoins. So if you're a customer and you have a stored balance at PayPal, you can leverage and access a stablecoin to pay someone, to send a remittance, to do a payout, to fund an account. And that's what I think has really been the driving force. And the Genius Act for me is what's really exciting, is that it's going to increase accessibility to effectively every single bank. So the ability to access a stablecoin as a payment method, as an alternative payment method, is only going to increase. So that for me has been the increase in velocity, has been the access to this technology. Now that doesn't solve every part of the use case story, but that distribution of this technology is core. So for me, I sometimes use this analogy of the iPhone. The distribution of this technology is equivalent to everybody having an iPhone. Now that distribution is there, then there's going to be this massive acceleration of the application layer or the app store. And that's what you're starting to see. Now that there's been this massive distribution of stablecoins, in the same way there was a massive distribution of iPhones, the application layer can now be built at a great velocity. And I think you'll see a similar sort of trend there.
You're totally spot on. It's funny you brought up the iPhone, because one of the analogies that I often use is, when you land, like let's say you travel somewhere, you turn your phone on, your phone usually ends up connecting to some network that your provider has some partnership with. Rarely are you asked, like, which technology do you want to use, right? Like, how do you want to do encryption here? You don't get asked. But to your point, like, I think the way that the technology, blockchain technology is specifically what we're talking about, the way it's getting distributed, but even better, the way it's getting hidden behind like a certain veneer, which then provides this seamless transition for the average customer. I think that's the inflection point that we were kind of waiting on. And that inflection point, I don't think was going to happen without the larger institutions getting comfortable with it and then kind of providing the adoption.
Yeah, I think that's definitely part of the story. I definitely don't think we're anywhere near where we need to be in terms of adoption. But I think you pinpoint something important, that when we stop talking about this technology is almost when it becomes mainstream. And so we break down that construct of what does it mean for this to become mainstream into three main buckets. One is technical abstraction. If you're receiving a stable coin on, for example, Ethereum, you need a fraction of Ethereum. Same thing with Solana to send and receive. Abstracting away that complexity so that customers don't need to think about, hey, I need a fraction of Solana, is critically important. The second thing is interoperability. I do believe that we're going to live in a multi-stablecoin world and a multi-chain stablecoin world. And if you think about what that means from a permutation perspective, that's huge. If you have, for example, 20 meaningful stablecoins across, say, or 100 meaningful stablecoins across 20 different chains, that's close to 30 million permutations. So that interoperability segment is really, really important. And then the final piece is what we call the usability for end users. If I want to send you a stablecoin today, the definition, and we're both use stablecoins in terms of so we understand this, but we understand the technology. So one, the fear element is gone, but the number of questions I have to ask you are too many. What stablecoin do you want to receive? USDT, XYZ, and that question is going to become much bigger. And then secondly, on what chain? And USDC is on 22 chains now. So the Genius Bill is really exciting because it's going to create this massive distribution of technology. But also what it's going to do is create this massive fragmentation at both the asset layer, i.e. more stable coins, plus at the network layer. And so you're going to have many more permutations. And so one of the things that we've innovated is what we call our auth product, where customers don't need to think in terms of assets and chains. They effectively authenticate into their Coinbase account or their Robinhood account, and they can send those funds without needing to think of chains and assets. So I think Zero Hash solves the technical abstraction piece, the interoperability piece, and the usability piece. And now we're really keen to kind of accelerate those three elements to our different users and applications. But that to me is the promised land for stablecoins. When we stop talking about chains, and we stop talking about stablecoins, it just is the most efficient, seamless, best way to move money and value cross-border or, within the same country. That to me is the unlock.
100% agree. 100% agree. If you look at the various institutional usage where Zero Hash is kind of powering the interoperability, the usage, etc., what are some like the main use cases there, right? Like, so if we can kind of dive a little deeper into the main use cases specifically around, is it the funding of buying of assets, like in the case of BlackRock? Is it trade finance? Is it actual business to business payments? Like, can we dive a little bit deeper into the actual use cases that are being, because I want folks to kind of then listen to this and say, my company does that, and this is why we should probably start using stablecoins, and then this is why we should actually talk to Zero Hash.
Yeah. So I think you mentioned it. Why Zero Hash has been particularly strong is really productizing the edge in a very seamless way so that a unique user can come and to use one API endpoint for exactly their use case. And so we service a whole range of use cases and applications. Maybe I'll talk about just two applications that are very fast growing, and we've released a ton of data on these two, so I can be very transparent about them. The first is account funding. So this is funding your account, and this is, again, it can be a crypto account, but largely it's traditional brokerage account. It could be a gaming account. It could be a fintech account. And account funding effectively is Zero Hash abstracts away the complexity for our partner such that they just receive dollars or the local fiat currency. The user sends stablecoins on any chain, on any asset, or any asset on any chain, and we convert and then give dollars instantly to our partner. So I'll walk through just a couple of examples.
Sure.
One is we do this with a regulated clearinghouse, such as Kalshi. Kalshi just wants to receive dollars on a Saturday and Sunday, for example, or overnight, because the system is closed, right? And you could really see this in the presidential election, whereby the presidential election was on a Tuesday. If you wanted to fund your account with, for example, ACH or any other mechanism, the period of time for settlement after Friday was too late. And so stablecoins really resolved the problem and has continued to grow as a meaningful funding mechanism. Same thing with Tastytrade, another that's a regulated brokerage firm as well. And so then we've also done this with regulated funds such as BlackRock's Biddle Fund and Franklin Templeton. And in each of these applications, what the merchant or what we call the platform, i.e. Kalshi or Tasty or Franklin Templeton, they're saying, look, we want to accept stablecoins, we understand the value of them, but we don't want to have to think about spinning up addresses. We don't want to deal with the cryptographic complexity. We don't want to deal with the on-chain transaction monitoring. But we understand that there's a massive value proposition to us, which is there's no chargeback risk. And we can accept funds from many, many different countries much more quickly and instantly 24/7, 365. And there's these huge trends that are accelerating that need, which is, for example, events-based trading, the increase of overnight trading, and tokenization. And I don't think you can have those conversations without the importance of stablecoins. And so we released, Tasty went live with us, a few days ago. And we released that in the first week, we've seen funding from over 35 different countries. So it allows a group like Tasty to have a global client base, a global funding base. And that is a huge value proposition. So that's our account funding product. And we're going to see a massive acceleration there with more and more announcements from traditional brokerage firms, traditional clearing firms, gaming firms, all sorts of fintechs that need money and the velocity of money to allow customers to transact more easily. That's one bucket. Another bucket, for example, is account. And these are all real clients that I'm talking about. These aren't hypotheticals. They're in the wild. You can go today.
Names. Yeah.
Yes.
Yeah.
The second is payouts. So we actually fund, for example, Stripe's payout product. And, there's a whole host of different segments of customer there. You've got, for example, remote.com is public about this. And our thesis is that every two-sided marketplace will leverage stablecoins as a payout method. And the value proposition here is, one, we're seeing an increasingly globalized world. And two, the velocity of money to that globalized world and cross-border is cumbersome, it's slow, and it's costly. And stablecoins allow you to pay people instantly. So I'll bring this back to like a core use case for us. We use stablecoins to pay a lot of our remote team themselves.
Fantastic. Yeah.
And the reason for that is, like any business, we approve payroll on a Wednesday, wires go out on a Thursday, and people receive their funds on a Friday, right? That's how it works for the US.
Yeah.
We're now 50% of our team is actually not in the US. So that means that potentially in certain parts of the world, those people are not receiving their payment for 4 or 5 days. Now, if it's not acceptable to pay people who are employees at the company late, right? But there is a functional challenge around the payment rails globally. So stablecoins solve those problems. And so we're doing this for a whole host of different companies. We've released data in terms of the top 10 countries that we've done payouts to. Again, major firms using this. We will have a bunch of different payroll companies, two-sided marketplaces, leveraging this technology and increasing to accelerate this growth here. But the value proposition is very clear. As a paid platform, i.e., for example, Zero Hash as a firm, I want to make sure my team gets paid on time. I want to make sure that they receive the majority of their paycheck. These are fundamental things. Secondly, for the user, it's the same problem set. I want to be paid instantly. I want to receive the majority of my paycheck. And people often ask me, well, what do they do with the stable coins on the other side? There's huge infrastructure now to be able to use and spend these assets seamlessly. So for example, if someone's in Brazil, you can send them, for example, USDC into their new bank account. And there's a huge coverage of the Brazilian population, 100 million account holders. And they can hold that USDC. They can spend it instantly. They can do all these different pieces. Same thing with the Philippines. PDAX exists there. Huge infrastructure built around stablecoins. And that's what I think is often missed, is that the stablecoin infrastructure is so core now globally that it actually is a very, very easy method, and it reduces the user friction that previously existed. So those are two examples with very, very tangible clients that we're public about.
I think something that you pointed, which is the velocity of money. The velocity of money almost has to match the velocity of the trading assets now, right? Like, so people are talking about tokenization of stocks, like Robinhood did something recently that we've all read about, and then like just in general, like there's tons of tokenization of real estate that we're seeing. And I think what people don't realize is like, so quite often people say there was nothing broken with the system before, like what are we trying to fix? But you and I both know this, which is the fact that trading stops here in the US. Trading stops at 4:30 on an afternoon, and it, good luck. Like, I mean, if you're the average person and you're not an institutional buyer or seller, you really have no access to the markets till 9:30 or something, I think, on a Monday morning, right? And so the fact that now you can actually go 24/7 is huge. But then to your point, you need some way to kind of fund those trades 24/7 if the asset is available. So I agree with you 100%. The other thing I think is very interesting that I've noticed is that this concept of like on and off ramping, right? Like the way to convert from fiat to digital and digital fiat. And in the best combination of which that I've noticed is the combination of stable coins, receiving, somebody sending stable coins, receiving stable coins, and then, either using local real-time payment networks like a Pix, like you mentioned in Brazil, like, or SEPA in Europe, etc. But then the combination of that and like a card. Like, I find that very fascinating that people are able to now just use a regular card as well, right? To kind of spend their USDC or USDT or PYUSD balances going forward. How do you feel about that? I'll comment here. Like, I think we all were trying to move away from card usage, but then we find that card usage does help a lot in enabling the usage of stablecoins. I'd love to get your thoughts on that.
Yeah, look, I think it's about that last mile, right? So for example, on some platforms you can auto convert. So for example, if you're in the Philippines and you receive
Hmm.
USDT, USDC, you can set up, for example, an auto sweep into your local currency. And so there it's just your neobank, right? You just hold the local currency. I think others where there's a store of value construct around the stablecoin, the ability to spend that instantly
That's true.
without having to think about it is important. So it's effectively abstracting away the complexity on the receiver side around actually using stablecoins. I think cards are definitely part of that story. I think the infrastructure that others have built about the ability to automatically sweep and convert into local currency pairs are also important. So I think it's one leg of the usability story once you actually hold a stable coin.
That makes sense. If you look at most of these institutions that are using zero hash, and if you look at some of the potential ones that are out there that could be using zero hash, what are some of like the challenges that a treasurer or a CFO at one of these institutions would possibly be having that they could just maybe, if you can give them like a few pointers that they could think through better, right? Like, hey, we've got this cross-border flow. How do we adopt stable coins? Where would zero hash fit in? How do we, how do we think about usage of stable coins and usage of the right parties that can enable stable coins?
Yes, I think in terms of maybe start with the last part of your question, I think this is kind of the framework by which you assess stablecoin infrastructure providers. I think one is core trust, right? How long has this entity been around? What's their track record? What licensing do they have? What are their actual customers? What we're seeing now, there's a huge hype cycle around stablecoins. What we're seeing with groups is that different groups are making a lot of announcements that really don't mean anything, or they're actually paying the partner
Yeah,
to do something. And I think what that does is actually quite damaging because what it effectively creates is this delta between expectation and reality. And having been in the space for a long time, I think one of the challenges of building a business in this space that can go quite boom bust in very, very short periods of time is actually narrowing the emotional bounds and being pragmatic about what the problems exist today, what does it solve, but what is left to solve. So to frame everything around stablecoins as a panacea or a silver bullet, and to make a ton of hype announcements, I think is damaging to the actual use case because you create this jaundiced approach. A lot of groups approach this with a degree of caution, right? Um, there still is a caution towards this. And so there are still people in boardrooms say, look, I told you so, right? Of course, this was all hype. This is not real. So
yeah,
I think the the biggest framework for decisioning that we see from major banks, and as part of our fundraise, we brought in several major banks. We have banks as clients now that have moved very, very quickly post Genius. Um, is really a trust factor, a risk factor. This stable coins are not going to go from 0 to 100% of anyone's flow. It's a
that's right.
meaningful, I believe it's going to become a meaningful portion very, very quickly, but you cannot threaten the core. And so I think the core questions that come up are, one, what is the value proposition, right? And being very pragmatic about the value proposition. So for example, we spoke to one of the largest merchants in the world, top 20, a very large two-sided marketplace. And, we said the usual spill. Stable coins as a payout method are really efficient and clean. And he goes, the person we're dealing with who's on the C-suite there said, look, you're missing the core point. I actually want the two-sided flows because if I can net
Interesting.
out between the one side of the marketplace and the other side of the marketplace, I
Hmm.
actually can net out those flows and then I'm not held with a ton of currency. But if my payers are going to, I understand the use case for the for the person providing the labor. But the person paying for the labor, largely is going to keep using the local currency. So what will happen is I'll receive a ton of local currency, right? And with stablecoin payouts, because I believe it's actually immensely valuable, the amount of local currency and pens of payouts will drop. So what have you done to my business? Now I'm long a currency I do not want to be long on. So you bring another degree of connectivity. So I think being very pragmatic about the use case and applications and solutions and thinking through these two-sided pieces, I think is really important. And so what I say that as meaning that you have to solve both the supply and demand. Often people think, okay, if you solve the payout story, that's meaningful. But what that conversation really taught me is that when you approach these large enterprises, you have to approach both elements of the conversation. So always in terms of risk, right? How do you make sure this is presented in a way that really demonstrates that this is not something that the person that you're dealing with will lose their job, which is a framework, a risk approach that people take. But secondly, I think you have to solve both what you would call like the mint flow and the burn flow, right? You can't just be one-sided. And that's really, I think, really, really important. But to your question around, for example, B2B flows, treasurers and other applications, I think the core value proposition is that effectively you reduce the cost of capital meaningfully. But what that means is that the fee by which Zero Hash charges has to be cheaper than the cost of capital, than just the expense of holding cash. And so I say that to mean that not all use cases in stablecoins are born equal. The value we take great pride that we price by value proposition. So with account funding, the margins can be higher because I am happy to fund an account and pay a slightly higher fee because I believe I'm going to fund my brokerage account. I will do a trade, and most people, only rational people put trades on that they believe they're going to win, right? So I don't mind paying a slightly higher fee. Because my alternative is I don't place my trade. When you compare that to, for example, a payout or a remittance or a disbursement use case, the alternative is just the cost of capital. And so you have the price with cost of capital. So I actually think what's really interesting about our business is how we've been very good at productizing the edge, differentiating on pricing on the edge. But the reality is that a lot of applications of use cases are somewhat tied to interest rates, the cost of capital, not just the issuer. Right. And I think that's a really interesting point that we've learned by actually, in my mind, being the largest mover and infrastructure provider, in the space.
You talk about issuers. We're starting to see, right, especially with the introduction of the Genius Act, this increase in at least the headlines, right? Let's wait and see like what actually happens in the market. But all of a sudden, every bank says they're going to issue a stablecoin, right? Like there's a lot of different financial institutions that are saying they'll issue their own stablecoin. Non-financial institutions that probably hold large treasuries, for example, that are looking at, and then you've got this like weird like interest-bearing, non-interest-bearing stablecoins. Like, what are your thoughts around? First of all, so many entrants entering with their stablecoins. Because I don't think all of them are going to be circulated like a USDC or USDT, right? I'd love to get your thoughts on like issuance of stablecoins and then like this weird like interest and non-interest.
Yeah, so I think when you look at Circle's financials, what that really shows is that distribution is where a lot of the margin accrues. To your point, there's going to be many, many more issuers. And that actually ties into my point earlier about the importance of interoperability. There will be many assets across many chains, and that is only going to increase. And it's really an argument over, or it's really a race towards the interest accrual. I do think, though, that long-term interest will have to accrue with distribution partners and or the end consumer. And that's going to be a reality that changes. Now, the Genius Act created this artificial distinction that a stablecoin cannot be interest-bearing. Now, there's some nuance about whether you can do rewards in certain instances and use cases and applications. But it did create this ability for a huge amount of interest to be maintained by the issuer, which is attractive to people. I personally think that when I look at stablecoins, I think people get the metrics all wrong. I do believe that stablecoins are a really, really important store of value, and that's where the AUM story is important. But I believe that we've become very binary in the way that we talk about stablecoins. The vanity metrics that people talk about are purely, this is how large my stablecoin is. I think we've got to start talking in terms of total processed volume. all your questions to me about usage and all these sorts of pieces, just putting cash and holding it and not using it, that's not that interesting, right? Like, we have, people outside of the United States, yes, there's this argument that stablecoins give them access to a store of value. That's definitely true. But there are alternatives, right? You can open up a Payoneer account in certain parts of the world. In other parts of the world, you can buy fixed income in the United States. So you're effectively getting the dollar exposure by holding fixed income. And that's a really meaningful part of people's business, like Nomad in Brazil. So for me, I think the stablecoin conversation has to move towards more of a TPV metric. And I think that's what is interesting long term. And I think that the economics are going to have to force everyone to start talking in those sorts of terms as well. Because AUC is interesting when you can keep 100% of the interest. When you have to give that all back to the customer, it becomes less interesting, right? So yeah. I think somewhat the vanity metrics are tied to the economic structures that exist today. I do believe strongly that it will change, that interest will be able to be passed through to the end consumer. And I think that will change the way that issuers are going to have to think about the economic model. I think that's going to change the metrics that people talk about. And I also think it has created some opening for groups to come in and be very, very aggressive. We're going to give you all of the interest, right, to the distribution partner. So there's a lot of conversation. I do think there's space for innovation in the stablecoin space. But all of this ties into our thesis very, very well. More stablecoins, more chains, increases complexity. What does Zero Hash do? It makes complex very simple.
Yeah, no, you're spot on about the volume aspect of it versus TVL, because I think TVL, I wonder how much, Edward, like this whole concept of TVL market cap is, it's almost like a bleed over from all our existence from the banking world, where the more assets you had under management, which is AUM, right? And so we kind of measure that metric more, but truly there's more value in a single $100 note being exchanged between 10 people 1,000 times versus each one of them just having $100 in their pocket and they're just walking around, right? Like I completely agree with you on that.
The velocity of money is what stablecoins do. And that, frankly, is the promise. If you can increase the velocity of money, that opens up the ability to grow GDP, to completely eviscerate certain industries that I think shouldn't exist, right? Payday loans. What is a payday loan? A payday loan is money I've already earned and I'm getting it early. If you can increase the velocity and reduce the cost of moving money, that payday loan shouldn't exist, right? Because a business could say, look, I'll pay you daily. If you're an Uber driver, you could be paid after every ride. That's the interesting story for me, is about the velocity of money. Yes, the store of value I do not want to underplay. It's certainly part of the story. But I think that the core value, this ties back to our kind of mantra internally, we want to enable the movement of value at the speed of ideas, right? And that brings a huge value proposition. And if you look at any economic paper, the velocity of money is a great indicator for growth. And that for me is what excites me about stablecoins.
Even from an institutional perspective, like I noticed this when I was with MoneyGram, you kind of mentioned like payday loans. It's kind of reflected at a much bigger scale with a bunch of more zeros attached to it in the form of pre-funding accounts. So the institutions have like these massive amount of capital that just sits, especially remittance companies and most cross-border money companies that have hundreds of millions of dollars stuck and they don't do anything. And to your point, like this was one of the things that we were looking at with Circle, which was like, hey, could we use USDC to actually reduce the amount of pre-funding that's out there for remittance and other cross-border companies? And I think to your point, like it is essentially our money, right? It just happens to be like it's stuck somewhere where it doesn't gain interest.
Yeah.
It's absolutely insane from that perspective. One of the interesting headlines that I noticed this past week was FIS and Circle working together. I thought that was really fascinating. FIS, as huge as it is, and with as many the plays that they have across the banking sector. Prior to the Genius Act, we had MiCA and we had all these other regulatory frameworks come about. Do you see like an interplay between the various regulatory bodies now? Because like ultimately, I think we need to get to a point where how if my bank was just going to send you a wire to your bank,
Yeah.
they don't know each other, but they trust that they're all operating on the same kind of level playing field. Do you feel like
Yeah.
that's kind of where we're headed from a regulatory perspective?
I don't know if it's going to. I think what the regulation has done is actually probably it's created massive. Like I said, it creates massive distribution of the technology, but the fragmentation is only going to increase, right? If I'm JPM and I launch JPMD, and then you have Citicoin, like that interoperability increases. So, like I said, you're going to have many more stablecoins across many more assets. And so, if I'm Citi, I do want to accept JPMD and I do want to accept USDC and I do want to accept, say, 20 other stablecoins. But how does that actually tangibly work? And so goes back to the core, which is solving technical abstraction, interoperability, and usability. The regulation has opened up a massive opportunity. But if you're sitting there as a bank, there are still significant questions that need to be solved. And that's effectively where Zero Hash comes in, is solving those three core pillars.
Yeah, that totally makes sense. I'm a huge fan of the work that Zero Hash puts out, like especially from a reporting perspective. I find it very useful as an operator in this space that you guys put out some really good educational stuff out there. There's two that I want to highlight, and please, if there's others, let me know. One is the work that you guys put out around freelancers and how like their adoption, and actually they want to hold stablecoins. I think it was like 75% or some really high number.
Yeah,
And then
based
the
on the
second
countries that we geoed, yeah.
Yeah, and I thought, because this actually came out like I think a year ago, if I'm not mistaken, from that report. The latest one around fantasy sports, right? Like,
Yeah.
so I thought that was fascinating as well. If you can kind of touch base, like, what is it about these sectors? Like freelancers, I think we can kind of summarize for ourselves, but the fantasy sports piece, like, I mean, these are some of the examples in the report are US-based companies which has, access to, everything, like Venmo, PayPal, etc. that are real-time 24/7. What is the uniqueness around stablecoins that Zero Hash is providing in that specific space?
Yeah, so Fantasy is leveraging our account funding product, and it really solves the problem set of the similar story that I gave, for example, of Cowshy or of Tasty Trade, which is instant, real-time funding, and the ability to send funds instantly where the merchant has no chargeback risk. And those are the core value propositions that we've seen. And these reports, we pay for them, but they're completely independent. We engage a third-party independent entity to show that. So yeah, I'd encourage people to take a look at that in a little bit more detail.
Yeah, and one of the things in the fantasy sports side, in general, what I've realized is that payouts are usually done using, push to debit or some product like that from Visa or MasterCard Send. And I think if somebody does the math on using stablecoins, it actually comes out quite more cost effective to use stablecoins if you're pushing out, like you said, at the velocity at which actual winnings, etc., would be pushed out. There's a market difference. I was doing the math earlier, and there's a market difference between using traditional rails to constantly be accepting and pushing money out versus using stablecoins, which I think is really key from that perspective. Where can people find you, Edward? And how can they find out more about Zero Hash?
Yeah, they can find me on LinkedIn or X. So yeah, please do give us a follow.
This was great. Thank you so much for your time, Edward. I hope to have you back on the show pretty soon.